The yen is now on its longest winning streak against the dollar in more than a year and a half. Concern about the global economy is sending investors to the yen as a safe haven play. Joining us now for more on the yen's move is a Bloomberg best. He is the overall best currency forecaster and best dollar-yen forecaster. Shaun Osborne is the chief FX strategist at TD Securities. Shaun, glad to have you with us this morning. Is it all about safe haven play? I mean, how annoyed must the Bank of Japan be right now?
I think they're going to be very concerned. I think to a large extent the short-term moves we've seen here is really driven by the safe haven flows. As you say, we can see overnight just equity markets and commodity prices have slipped off. But beyond that, I think there are some other reasons why the yen is particularly strong at the moment.
Sentiment-wise, though, Shaun, I don't mean to cut you on, but do you feel like investors' reaction is just risk on, risk off, and it's either one way or the other?
I think that's exactly right. It's a very binary market at the moment, and investors are either in risk-seeking mode or not. And we can see that over the course of the past few months, as equity markets have drifted off and US yields have slipped, the dollar-yen rate has continued to grind lower.
Do you think it's odd, though, when you look at the fundamentals for the yen? I mean, do you see the currency trading differently over the next 12 months? I mean, the Japanese economy has its own woes. I mean, we certainly have them here in the U.S., but Japanese economy, no stranger to debt.
That's very true. In fact, from a longer-term point of view, I think the fiscal challenges facing Japan are probably even more immense than even the challenges facing some of the European or even the US. So there are certainly some longer-term issues there. But from a shorter-term point of view, over the course of the next few months, I think it is going to be a case of risk and the fact that principally yield spreads are so low. We've seen the 10-year spread between US and Japanese government debt collapse by about 100 basis points over the last 3 or 4 months. And that is one of the principal reasons why the dollar-yen rate, I think, has slipped, in addition to getting additional juice from the bouts of risk aversion that we keep seeing filter up through the markets. So,
Shaun, where do you think that dollar-yen finishes the year?
We'll think we'll probably end up around 85, but our year-end forecast is in fact right around 85. But we do think there's a fairly substantial risk that we dip back towards that 90-95 low and retest the 80 level. That probably is some sort of very unscientific line in the sand for the Bank of Japan at the moment. I think if we do slip back towards that point, then the chances of intervention are probably going to rise quite considerably.
Okay, well, that was my next question. So can you put it on a scale of 1 to 10? I mean, if we see that level around 85, does that necessarily mean that the Japanese government intervenes?
I think the probability will rise quite substantially. It's very difficult to put an absolute level on that, but I think that what the Japanese authorities are going to have to weigh up is the balance of risks, I guess, between intervening and the chance of successful intervention. I think there's a strong chance of intervention, but I think there's a very low chance, if you like, of successful intervention here, just because the headwinds against the dollar-yen exchange rate at the moment are very substantial, not just the yield, the risk aversion. But we can see from a number of very basic macroeconomic fundamental issues that it's very difficult for the Japanese to argue, in fact, I think at the moment, that the yen is overvalued. We saw just recently a very decent trade report from Japan. Exports are growing quite strongly. In real effective terms, the yen is not overvalued.
Shaun, we have to leave it there. Thanks very much to Bloomberg Best, Shaun Osborne from TD Securities.